Well, half of 2023 is behind us, and this is not going to be a regular weekly summary. This is going to be not even a quarterly summary. We're going to summarize the first half of 2023, where too many people were too overexposed to sectors that just didn't perform. And if you're the other half, the half that invested in the right stuff, well, 2023 so far has been marvelous. Let's talk about everything that's happened and, of course, what else is going to happen in the rest of 2023. Are you ready for it? Let's go! Hello everyone, welcome back to the channel. I'm Micha Stocks from our channel Stock Talk with Micha Stocks, where we usually have a weekly summary. And as I mentioned in the intro, in this video, let's talk about 2023. There isn't a better way to start talking about 2023 than this one. Most of the investors out there came into 2023 with these thoughts in mind. The end of the economy is coming any minute now. Hold your horses, wait for it. Everyone was waiting for the collapse. And when everyone is on one side of the boat, this is what happened. When we look year to date on the performance of the major averages, the Dow Jones, which it comprises of only 30 stocks, went up 3.84%. S&P 500 of the biggest, best-run companies in the world, up 16.3%. NASDAQ leveraged more on technology, 32.7. If you include dividends, it's a lot higher. And the Russell, 7.8%. And actually, it's lagging mainly because of the regional banks that were lagging. When we look at the crypto market, Bitcoin is up year-to-date 84%. Ether is up 60%. This is how the different sectors performed year to date. You can see the XLY, which is consumer discretionary, XLC, which is communication, and XLK, which is technology, up 32 to 40% year to date. Other sectors lagging behind in a very substantial way. XLU utilities down 5.7%, XLE down 5.4%, XLV more around healthcare down 1.5%. So utilities, energy, and healthcare down. Rest are up a bit. And of course, the top three are the top three. Look at the money that flew into these different sectors. You can see technology got most of not only the gains, but also increased its market cap, while healthcare, energy, and utilities lost a bit of their market cap. What you mainly can see on this chart is that money came into the S&P 500. And money came into the S&P 500 to these sides: technology, consumer discretionary, and communication services. The Marvelous Seven. Here they are. A new term. After FANG, we now have the Marvelous Seven. It's Microsoft, it's Google, it's Apple, it's Meta, it's Nvidia, it's Amazon, it's Netflix, and it's Tesla. 7 of the best performing stocks, all, of course, leveraged in technology. You can see the percentage here. You can also see the sporadic gains around financials because of all the financial turmoils that happened during the first half. And, of course, energy, very, very bad performance thus far. This does not mean that past performance will happen in the future, by the way, but this is how the first half looked like. By the way, Apple just finished Friday at a $3 trillion market cap when it closed the trading over $3 trillion. By the way, Apple gained year to date $954 billion in market cap. Right after that, Microsoft gained $742 billion in market cap, $390 by Google, and all the rest. And this is thanks to Bespoke that is sharing with us all this information. A lot of money came into a lot of stocks. Money is coming back into the stock market, and that's one of the biggest, let's call them, revelations of the first half of 2023. By the way, we follow 2023, actually, just like we follow 2022, or at least half of it, every week on our weekly summary. If you're new to the channel, it would be great if you can subscribe to the channel right up here on the right and turn notifications on, where you will be updated on a weekly basis on what's going on, all the news and everything. This is, of course, a special feature for the first half. I want to say this is the best way to summarize the different perceptions in the market. Samro wrote this quote: "Son, I got a new job. Mom got a raise. We have more cash in the bank. Gas prices are falling. My 401k is up. Your 529 is up. And my company is expanding thanks to growing profits. But we are not going to go to Disney World this year because the yield curve is inverted." And why is that a joke? And nobody has ever said that, because the latter part of the sentence is what really happened, what really influences people. The curve inversion of the 10 and the 2s, which is inverted for several months now, actually almost a year, inverted, usually giving us a heads up that there's going to be a recession. But the recession isn't coming because the job market is very strong, companies are strong, stock market is up, which means that 401ks are up, etc., etc. And this is a great, great quote. GDP is also up 2% rather than 1.4 in Q1, which again pushes the narrative of the recession further away. Might happen. Still, everything I'm saying is summarizing H1. Doesn't mean it's not going to happen in H2. And also, we might see, it actually was decided in H1 that they're going to fight Elon Musk and Mark Zuckerberg. Will it happen in the Colosseum instead of Vegas? We'll see that. Let's dive back in. So, Marvelous 7, everyone is talking about Apple, $3 trillion. Everyone's talking about Microsoft and Google and everyone else. But guess what? Even McDonald's, McDonald's, the same McDonald's that we all know and love, not new, all-time high during 2023. So the market is gaining steam across different sectors, not only technology anymore. This brings the fear and greed to a very, let's call it, challenging spot, where now people are starting to become greedy. They want to buy. They see everything going up. That usually is an indication that we might get a pullback. We might see a correction, and that's fine, especially if we are entering a new bull market. But still, you can see from an insider, from a market insider, a headline from June 28 that said the Fed thinks catastrophe is coming for the US businesses. The bears are still pounding the drums, saying we are going to drop. But the data isn't supporting them. Real disposable income is growing, or grew during the first half. Look at the problem that money managers are having right now. After ending H1, convincing their customers to move money to money market funds, which gave them about 2.5% in the first half, while the NASDAQ gave 37, 35, 40%. How can you explain to someone that gave a professional investor his money, or her money, and gain only 2.5% versus 37%? This is going to be the narrative for H2. How can we chase those gains? How can they chase those gains? Because retail performed very well in the first half, because retail is a lot more agile and usually bets on companies and not only others. And during 2022, S&P didn't look that way. This is year to date. NASDAQ didn't look that way. This is year to date. They were down, but energy stocks were up. So I looked at energy stocks this year. Let's say you didn't listen to our weekly summary every week, and you said, you know what would happen in 2022 would probably happen in 2023. Well, guess what? The XLE, the spider index that has underneath it a lot of energy stocks, is down 2%. By the way, if you said, you know what, I'm even betting on a specific company, I'm going to stock pick Chevron, CVX, down 7.8% year to date. This does not mean they're not going to go up, by the way. Past performance does not, of course, have to happen in the future, but no doubt the energy trade not only was it crowded and crowded for the wrong reasons and underperformed in a very, very severe way. When we look at the stock market or actually the labor market, Morgan Stanley on a research published June 28th is strong, supporting a soft landing. Daily Economy briefing also used resiliency on display. The US economy is strong. Bloomberg and Jonathan Levine is asking, maybe we should cancel the recession. Maybe there isn't any recession. Maybe it was the most anticipated recession. That's why we didn't get it. And of course, the Wall Street Journal also said US economy shows surprising vigor in the first half of 2023. Look at Carl Quintanilla. Again, I'm taking a few tweets from Carl that actually is forwarding from Goldman Sachs' desk. Look at the seasonality that we are entering. Actually, in the next 2 weeks, we are supposed to have one of the best 2 weeks in the trading period of the year. Why? Because of window dressing. Let me just explain to people that don't know what window dressing is. And no, I'm not talking about Macy's on the 34th in Manhattan. Window dressing, professional money managers at the end of H1, or actually a week or two before end of H1, are posed with a very difficult situation. They know that they're going to send their customers a report card. Those customers are going to say, am I invested in these stocks? Which are the stocks that they're going to ask? Stocks that went up the most. What would you do if you were not invested in Nvidia, in Apple, in Microsoft, in Google, in Tesla? What would you do? If you're a professional money manager, you would probably window dress that report. You would buy a few stocks. You would make sure that if your customer, if your client calls and said, all right, am I invested in Nvidia? You would say, of course. What do you mean? Of course you are. Look at line 65. You have Nvidia in your portfolio. Don't worry. Now, of course, I'm doing it in a very theatrical way, but that is behind the scenes how it works. Now, this is why after H1, there are usually 2 weeks of gains. Historically, statistically, does not mean that that's what's going to happen because of window dressing, not because of any other reason. Paul Hickey from Bespoke came to CNBC yesterday and says, look, who says that July hike is happening? There's no reason for it. Look at the rate hikes. Market's going up even if there is a rate hike. Who says there needs to be a rate hike? We even eliminated or avoided the debt default. When you look at the CPI every month that is published, you can see it went down from 9.06 to 4.05. By the way, mathematically, if we have a print that is 0.1 or 0.2 on the CPI, because of the math, not because anything, not because you went to the supermarket or to Costco or any place else and the prices went down, just because of the math, the way it's calculated, we are going to see a calculated print of under 3%. Why would they raise rates if that is the case? And the last part of this video, or before the last part of this video, is how everyone is looking at the future and trying to predict the future. Before I present this, I'll tell you the following. I did not travel time. I have no idea what's going to happen in the future. I'm looking at the data as it comes in and I'm trying to figure out what would be my next steps. Nothing here is financial advice. Everything is for entertainment and, of course, for educational purposes only. And in the next 3, let's call them slides, you will understand how difficult it is to predict the future. Bespoke looks at the history, says, look, if the market went down and then went up, historically, we're supposed to go up in the next year. That's according to Bespoke. I'm not going to go over the numbers. It doesn't really matter. Tom Lee from Fundstrat says that he sees another 12% gain during 2023. Why? Because of momentum, because of a lot of things that he's calculating. Carter Braxton Worth from Worth Charting, the chart master, looks at all the years that we have excelled the gains at. 15.9 is the lowest, and he went back to take first halves that are very, very strong. According to this chart, you can see that second half wasn't that good. So maybe we're not going to see a green second half. And to close it off, Ryan Dietrich from Carson Group shows that statistically we are supposed to get between 5 to 15% in the rest of the year. So are we going to go up? Are we going to go down? Let's talk about sentiment. Right now, sentiment is changing. It's changing slowly, depending on the groups. If you're in the retail investment, it probably has changed already. You already see the gains. You look at your app or whatever the way you're managing your portfolio, and you're saying, I have no idea what they're talking about. I'm seeing green all over. That's great. But big institutions are still playing defense. They still believe in a recession that is coming. The economy is going to slow down. Earnings are going to be hurt. They're still negative at the market. Yes, they're starting to be exposed. That's why we see money coming into the market. But still, they are underweight equities still, which means that when they change their narrative, when they change their sentiment, we will see a flood of money coming in just because that's how it goes. So how can you, as a retail investor, follow that? To tell you the truth, just look at the charts. I'm using an app called TradingView, but you can do the same thing on Yahoo Finance and any other place. I want to eliminate the chart for a second and just show you two lines in color. One is green and one is red. The green represent what is called the 50-day moving average. 50-day moving average takes the last 50 days, sums them up, and tries to figure out what is the 50-day moving average. That's how it plots the green line. It divides by 50 at the end. Sorry, I forgot to say divides by 50. Then the 200 takes 200 closing prices from today backwards, divides by 200. That's how we get this plot of moving average 50 to 200. This crossing and this crossing in technical analysis have a name. When the 50 moving average drops underneath the 200, it's called the death cross. Usually it predicts the market going down. When the 50 goes above 200, usually it's called the golden cross, where the market is going to go up. Let's pull up the chart again. Let's see what would happen if we would follow these signs. If we would follow these signs of 50 dropping underneath the 200, we would have sold, let's put back the numbers instead of percentages, just a second. We would have sold the S&P 500 when it was, this happened here. Let's say we missed this small bear market rally. We would have sold the SPY at around 41.60. By the way, it happened again when the S&P was around 3,900. We would eliminate a lot of this drama, and we would pick up 39 to 44, 20%. Yeah, 20? No, 10%, 12%. So should we follow these signs? Well, nothing is automatic. But if we see the 50 changing direction like it did in the past, and falling underneath the 200, it would give us a good indication that trouble is coming. If that doesn't happen, it doesn't mean that there won't be corrections. There will be corrections over time because, as you can see, the S&P goes up and down, up and down, up and down. It happens. But it doesn't mean that the market is going to fall. The sky is not going to fall. And it doesn't mean that we need to go in the middle of the city with a board that says the end of economy is coming. Probably more than half of the people, because we're retail investors, had a very strong first half. And that is great. During the second half, we're going to have more challenges. We're going to have the challenge of the bears that need to capitulate. They need to decide that the market isn't falling. We need to make sure that the market isn't going to fall, because if it's going to fall, then they're going to come up right. We need to make sure we're protecting our gains. Why? Because again, trouble might come. But we also need to look at the opportunities that the market opened up for us. Sectors that are underinvested. Areas which just had a bad 6 months. Not sure it's energy, not sure it's healthcare, but I don't know if they're not going to overperform in the next 6 months. What I do know is one thing. I'm going to be here every week to provide you with all the news, everything you need to know. So, if you enjoyed everything during this summary, you can smash that like button, and we will meet again next week on a regular weekly summary. Till next time, I'm Micha Stocks. See you next time. Bye-bye.